Picture this. It's 2008 and a financial titan that's been around since the Civil War suddenly crumbles overnight. The stock market plunges, homes are foreclosed, and the world economy grinds to a halt. How did one bank, Lehman Brothers, trigger a crisis that would cost the world $10 trillion? Let's unpack this financial disaster. Lehman Brothers started small in 1844 as a dry goods store in Alabama, but by 2008, it had grown into the fourth largest investment bank in the US. How did they get so big? Well, in the early 2000s, Lehman rode the housing market boom like a pro surfer. They got really good at something called securitization. It's a fancy word for bundling mortgages and selling them as investments. At first, it seemed like everyone was winning. Homeowners got loans, investors got returns, and Lehman, they made money hand over fist. But here's the thing about meteoric rises. What goes up must come down. And Lehman's impressive growth, well, it was about to face a reality check that would shake the entire world. As 2007 rolled around, the housing market started showing cracks. Home prices were falling and foreclosures were on the rise. But Lehman Brothers, they doubled down. Instead of pulling back, they expanded their mortgage portfolio even further. It's like seeing storm clouds gather and deciding to have a picnic anyways. Let's talk about subprime mortgages for a second. Imagine lending money to someone who's already deep in debt and has a history of not paying it back. That's essentially what subprime mortgages were. Banks were giving out loans to people with poor credit histories, often with little to no down payment. It's like giving a teenager a credit card with no spending limit. What could possibly go wrong? Well, when housing prices were going up, this wasn't a big problem. People could always sell their homes if they couldn't make payments. But suddenly the unexpected happened. Housing prices started to fall. Suddenly millions of homeowners owed more than their houses were worth. And Lehman Brothers, they were holding a mountain of these risky loans. Now here's where things get really dicey. In 2007, Lehman had what's called a leverage ratio of 31. What does that mean? For every dollar of their own money, they were borrowing $31. It's like buying a $310,000 house with only $10,000 down. If the value of that home drops even a little, you're underwater. This high leverage ratio made Lehman incredibly vulnerable to market changes. Even a small decline in the value of their assets could wipe out their capital. It's like building a skyscraper on a foundation of toothpicks. One strong gust of wind and the whole thing comes tumbling down. Despite these warning signs, Lehman kept pushing forward. They underwrote more mortgage-backed securities than any other firm, accumulating a portfolio worth $85 billion. That was 4 times their shareholders' equity. It's like betting your entire life savings on a single horse race. Exciting if you win, but catastrophic if you lose. The first major tremor hit on March 17, 2008. Lehman's share price plummeted by 48% in a single day. Investors were spooked, fearing Lehman might be the next domino to fall after Bear Stearns' recent collapse. It was like watching a giant redwood start to sway. You know if it falls, it's going to take down a lot with it. But even as the subprime crisis unfolded, Lehman's management seemed to be in denial. They reported record revenues, claiming the risks were all well contained. It's like standing in the path of a tornado and saying, it's just a bit breezy. But then came the summer of 2008. In June, they announced their first quarterly loss in 14 years, a staggering $2.8 billion. It was like watching a heavyweight champion take their first real punch. The invincible giant suddenly looked vulnerable. But Lehman wasn't about to throw in the towel. They started a desperate scramble to save the bank. They tried to raise capital, selling off assets and even considering splitting the company in two. It was like watching someone trying to bail out of a sinking ship with a teacup. As the days ticked by, the sense of urgency grew. Lehman's stock price was in free fall, dropping 77% in just the first week of September. Investors were losing confidence faster than you could say subprime mortgage. The US government, which had earlier helped orchestrate a rescue of Bear Stearns, was sending mixed signals. Treasury Secretary Henry Paulson, or Hank Paulson, as he was more commonly known, was adamant there would be no bailout for Lehman. Lehman's options were running out. They reported a loss of $3.9 billion, including a $5.6 billion write-down. These weren't just numbers on a page. They represented the livelihoods of thousands of employees and the savings of countless. The weekend of September 13th and 14th in 2008 became the stuff of Wall Street legend. Lehman was desperately seeking a buyer. Bank of America and Barclays were in the mix, but both eventually walked away. And it was like watching the last lifeboats leave the Titanic. As Sunday night turned into Monday morning, the unthinkable became reality. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in U.S. history, with $639 billion in assets and $619 billion in debt. Stock markets around the world plummeted. The Dow Jones Industrial Average dropped 504 points in a single day. Credit markets froze. Banks stopped lending to each other, fearing they might be the next domino to fall. The collapse of Lehman Brothers wasn't just the fall of a bank. It was the moment the 2008 financial crisis truly began. The interconnectedness of the global financial system meant that Lehman's failures sent tsunamis through every corner of the economy. Millions of people who had never heard of Lehman Brothers suddenly felt the impact. Retirement savings vanished, homes were foreclosed, jobs disappeared, the world economy ground to a halt. In the days that followed, the U.S. government realized the magnitude of the crisis. They scrambled to prevent other financial institutions from collapsing. AIG, Fannie Mae, Freddie Mac. Suddenly, these were household names as the government stepped in with massive bailouts. The fall of Lehman Brothers became a symbol of the excesses and risks of the financial system. It exposed the dangers of complex financial instruments, excessive leverage, and the interconnectedness of the global markets. The collapse of Lehman Brothers wasn't just a financial earthquake, it was a global tsunami. The aftermath left the world reeling with $10 trillion in lost economic output. That's not just a number on the page, though. That's millions of jobs lost, retirement savings wiped out, and dreams shattered. Remember those subprime mortgages we talked about? They came back to haunt us big time. Millions of homeowners found themselves underwater, owing more on their houses than they were worth. Foreclosures skyrocketed, leaving entire neighborhoods looking like ghost towns. But the crisis didn't hit everyone equally. While many average folks were struggling to keep a roof over their head, the wealthiest individuals bounced back quickly. The widening gap between the haves and the have-nots, it's still with us today, and it's a lasting scar from 2008. So what did we learn from this financial disaster? Well, the government decided it was time to enter some new rules. Enter the Dodd-Frank Act of 2010. This massive piece of legislation aimed to put some guardrails on Wall Street's wild ride. One of the big changes was the creation of the Consumer Financial Protection Bureau. Their job? To make sure lenders aren't handing out loans like candy at Halloween. They introduced standards for safe loans and made lenders actually check if borrowers could afford their mortgages. Imagine that. But here's the million-dollar question. Are we really any safer now? Sure, we've got new regulations. The financial industry has a notoriously short memory. Some experts warn that risky practices are already creeping back in. It's like we're watching a sequel to a movie we didn't enjoy the first time around. And let's not forget about trust. The 2008 crisis didn't just shake the economy, it shattered people's faith in the entire system. Movements like Occupy Wall Street sprang up, giving voice to a generation feeling left behind by the powers that be. Speaking of generations, the aftermath of 2008 hit young people particularly hard. Many who enter the job market during or right after the crisis are still playing catch-up. They're facing lower lifetime earnings compared to their parents. It's like starting a race with their shoelaces tied together. So, have we truly learned our lesson, or are we setting ourselves up for another fall? As Susan Wachter, a professor at the Wharton School, pointed out, borrowers often assume that if the lender was making the loan available, it must be safe. But that was not true. This highlights a crucial point. Financial literacy isn't just nice to have, it's essential. So what have we learned from the Lehman Brothers saga? Well, it's clear that excessive risk-taking can have catastrophic consequences. Financial literacy isn't just for Wall Street pros, it's crucial for all of us. But are we safe now? While regulations have improved, some experts warn that financial crises are cyclical. One financial expert even said, "I can tell you with a high degree of confidence that we will see a banking crisis again." That's why it's so important for you to stay informed and approach investments critically. By understanding financial practices and learning from history, you can make smarter decisions to secure your own financial future. Remember, knowledge is your best defense against the next potential crisis. If you enjoyed this video, remember to like, subscribe, and comment, and I'll catch you in the next one.